Ladies and gentlemen, archivist here. We have spent the last few weeks documenting a crime scene. In our previous dossiers, we analyzed the specific forensic evidence of a massive capital flight. We watched China liquidate nearly $700 billion in U.S. treasuries to sanitize their war chest against future sanctions. We watched India quietly unwind $50 billion to pivot toward a sovereign gold standard. We identified the hidden buyer, the leveraged hedge funds and geopolitical proxies in the Cayman Islands and London, who stepped in to mask these exits. But today, we must look beyond the specific actors and address the fundamental mathematical paradox that is currently haunting the halls of the U.S. Treasury and the Federal Reserve. The United States government is currently issuing debt at a pace that is historically unprecedented outside of a total war or a pandemic. The net issuance for this fiscal year alone is projected to exceed $2 trillion. The supply of bonds flooding the market is torrential. Simultaneously, the real buyers, the entities that have historically anchored the global financial system, are stepping back. The percentage of U.S. debt held by foreign entities has collapsed from a high of nearly 34% a decade ago to levels we haven't seen since the early 2000s. The paradox is this: supply is exploding, organic demand is collapsing, and yet the market hasn't crashed. Yields are high, yes, but they are not at the crisis levels of 8% or 10% that a free market would demand for this level of risk. The auction's still clear. The government still gets its cash. The check's still cash. How? If the entities with the actual savings, the trade surplus nations, aren't buying, who is writing the check? To answer this, we must first deeply understand what we mean by real demand and why its disappearance is the single most dangerous signal in the global economy. For the last 40 years, the global financial architecture relied on a mechanism known as the recycling loop. This was the engine of the petrodollar system and the engine of globalization. It worked like this. The United States ran a massive trade deficit. We bought oil from Saudi Arabia, cars from Japan, and cheap consumer goods from China. We paid for these things in US dollars. These nations, China, Japan, Saudi Arabia, ended up with massive piles of dollars. But dollars earn no interest sitting in a vault. Because these nations wanted to keep their own currencies cheap to boost exports. Mercantilism, they couldn't just sell the dollars. And so they did the only logical thing. They recycled those dollars back into the United States by buying U.S. Treasury bonds. This was real demand. It was price insensitive. China didn't buy treasuries because they loved the yield. They bought them because they had to. It was a structural necessity of their economic model. It was long-term. These central banks were strong hands. They bought the debt and held it for 10, 20, or 30 years. They didn't panic sell when the Fed hiked rates. They provided the ballast for the entire U.S. yield curve. That era is officially dead. The recycling loop has broken and the real demand has evaporated. Let's look at the major pillars of this demand and why they have crumbled. China. As we established, China is actively hostile. They are not only stopping purchases, they are selling legacy positions. They are no longer recycling their trade surplus into treasuries. They are recycling it into commodities, Belt and Road infrastructure, and gold. The natural bid from the world's second largest economy is gone. Japan. Japan is the largest holder of U.S. debt, but they are now a forced seller. The Japanese yen has been under historic pressure. To defend their currency from collapsing, the Bank of Japan has to sell U.S. treasuries to raise dollars to buy yen. Furthermore, Japan is finally normalizing its own interest rates after decades of zero. This means Japanese life insurers and pension funds, who used to buy U.S. debt for the yield, can now get decent yields at home in Japan without the currency risk. The carry trade bid is reversing. The petrostates, OPEC. This is the most subtle but critical shift. For decades, Saudi Arabia and the Gulf states mechanically bought treasuries with their oil profits. But the new leadership in the Gulf, MBS in Saudi Arabia, MBZ in UAE, has changed strategy. They are no longer content to just hold paper. They are investing their surplus into their own domestic economies, Vision 2030, into global equities, into sports leagues, and into gold. They are diversifying away from the dollar. The petrodollar recycling bid is drying up, so we are left with a massive demand gap. The structural, price-insensitive, long-term buyers who funded the American empire for 40 years have left the building. According to the Treasury Borrowing Advisory Committee, TBAC, the demand from foreign official accounts, central banks, has turned negative. They are net sellers. This leaves the U.S. Treasury in a desperate position. They have $2 trillion of new paper to sell, and the only people standing at the auction window are domestic entities and leveraged speculators. In a functioning market, this loss of demand would force the U.S. government to drastically cut spending or suffer a currency collapse. But we do not live in a functioning market. We live in a managed system. And as we will see in the next section, the U.S. Treasury has developed a way to fake the demand using its own banking system, a mechanism that keeps the yields stable today, but guarantees a catastrophic explosion of the banking sector tomorrow. If the real buyers are gone, how does the U.S. Treasury announce every week that their auctions were solid? How do they move $100 billion of debt in a single afternoon without the price crashing? To understand this trick, you have to look under the hood of the market structure. You have to look at the primary dealers. The U.S. Treasury market is not a free-for-all like the stock market. It is a highly regimented system controlled by a cartel of large banks known as the primary dealer network. These are the giants: JP Morgan, Goldman Sachs, Citigroup, Wells Fargo, and others. To be a primary dealer is a privilege, but it is also a burden. By law and regulation, primary dealers are obligated to bid at Treasury auctions. They are the buyer of last resort before the Fed steps in. If nobody else shows up to buy the debt, the primary dealers must buy it. In normal times, when real demand is high, the primary dealers buy the debt and then immediately flip it to clients, to pension funds, to foreign central banks, to insurance companies. They act as a pipeline. The debt flows through them, not to them. But in the last 12 months, the pipeline has clogged. The dealers are buying the debt, turning around to sell it, and finding fewer buyers. We can see this in the auction statistics. We track the dealer takedown percentage. Historically, when demand was healthy, dealers might take down 10% or 12% of an auction. In recent auctions throughout late 2025, we have seen dealer takedowns spiking to 18%, 20%, and sometimes nearly 25% of the issuance. When a primary dealer is forced to buy 25% of an auction, that is not a success. That is a failure disguised as stability. It means that real demand failed to cover the supply. It means the banks were forced to eat the tail, the unsold inventory. This creates a phenomenon known as dealer indigestion. The bank's balance sheets are becoming stuffed with U.S. treasuries that they don't want and can't easily sell. This is dangerous because banks have regulatory limits, Basel III leverage ratios, on how much sovereign debt they can hold. When their balance sheets fill up, they stop lending to the real economy, they stop making small business loans, they stop underwriting mortgages, they preserve their precious balance sheet space for the treasuries they are forced to buy. This is how the demand gap in Washington suffocates the economy on Main Street. But the dealers can't hold it all. So, where does the rest go? This brings us back to the leveraged hedge funds and the basis trade we discussed in previous dossiers. Since the real buyers, or foreign central banks, are gone, the dealers are offloading this inventory to price-sensitive buyers, specifically hedge funds. But hedge funds don't buy treasuries to hold them for 20 years. They buy them to gamble. They buy them only because they can borrow cash in the repo market to finance the purchase. This transforms the nature of the national debt. When China held the debt, it was stable. It was cold storage. When a hedge fund holds the debt, it is volatile. It is hot money. The hedge fund will only hold that debt as long as the repo rate is low and the volatility is managed. If the trade moves against them, they sell instantly. Furthermore, we are seeing a rise in a nebulous category of buyers, often labeled as investment funds, in the TIC data. Forensic analysis suggests that much of this investment fund demand is actually just recycled liquidity from the banking sector itself. It is a shell game. The Fed provides liquidity to the banks via reserves. The banks lend to the funds buy the treasuries. It looks like demand, but it is really just balance sheet expansion. It is the financial equivalent of a snake eating its own tail. The auction clears, the headlines say strong demand, but the system has become more leveraged, more fragile, and more interconnected. We are essentially funding the U.S. government by stuffing the banking sector full of IOUs. This clearing mechanism works beautifully, right until the moment the banks say no more. Right until the moment the dealer balance sheets are full. When that happens, when the dealers can no longer absorb the supply, we will see a failed auction. Not a sloppy auction, a failed one, where the Treasury offers debt and literally no one buys it. That is the moment the game changes forever. That is the moment the Fed has to print. But before that happens, the system has one more trick to keep us compliant: volatility suppression. If the demand is fake, if the buyers are fleeing, and if the banks are choking on debt, why isn't the market crashing right now? Why is the VIX, stock market volatility, relatively low? Why is the MOVE index, bond market volatility, elevated but not catastrophic? Why does the 10-year yield seem stuck in a range instead of exploding higher? The answer is that we are no longer in a market where prices reflect reality. We are in a market where volatility is actively suppressed. The financial system has evolved into what analysts call a volatility laundromat. In a free market, when risk rises, like the U.S. debt spiraling out of control, volatility should rise. Prices should swing wildly as investors try to figure out the truth. But in the leverage regime, post-2000, volatility is lethal. Because the entire system is built on leverage, borrowed money, any spike in volatility triggers margin calls. If Treasury yields spiked 50 basis points in a day, the hedge funds holding the debt, the basis trade, would blow up. If they blow up, the banks that lent to them blow up. Therefore, volatility cannot be allowed. Stability is not a reflection of health, it is a mandate of survival. How is this suppression achieved? It happens through the shadow banking complex and the implicit guarantee of the Fed put. Institutional investors have been trained for 15 years that the Federal Reserve will never let the market crash. So, whenever yields start to rise too fast, signaling a buyer's strike, short volatility strategies kick in. Pension funds and asset managers sell volatility via derivatives to generate yield. This dampens the price swings. It acts as a shock absorber. They are effectively selling insurance on a burning house, betting that the fire department, the Fed, will arrive before the roof collapses. This keeps the market looking calm on the surface. But risk is like energy. It cannot be destroyed. It can only be transferred. So where did the risk go? If it's not showing up in the price of volatility, where is it? It is hiding in the liquidity risk. The market depth, the ability to trade large amounts of bonds without moving the price, has collapsed. In 2005, you could sell $500 million of treasuries and the price wouldn't budge. Today, a $500 million sell order can gap the market. The market is thin. It is brittle. It looks calm because everyone is standing still, terrified to make a sudden move. The primary dealers are warehousing the risk on their balance sheets, hoping they can offload it slowly. They are engaging in internalization. Instead of selling the bonds to the open market, which would crash the price, they hold them, hedging the risk with derivatives. This masks the true lack of buyers. It creates the optical illusion of a functioning market. The stability is deceptive. It is the stability of a dam holding back a flood. The water level, debt supply, keeps rising. The dam, dealer balance sheets, is under immense pressure. But as long as the concrete doesn't crack, the village below sees no water. They think everything is fine. However, this suppression mechanism has a cost. By artificially suppressing yield volatility, we are distorting the price of money for the entire world. We are blinding the economy to the true cost of the U.S. deficit. If yields were allowed to rise to their natural level, say 7%, Congress would be forced to cut spending immediately because the interest payments would bankrupt the nation. By suppressing yields to 4.5%, we allow the spending to continue. We allow the debt to grow. We are prioritizing short-term stability at the cost of long-term survival. The suppression regime guarantees that when the break finally comes, it won't be a correction. It won't be a bear market. It will be a discontinuity. A gap-down event where liquidity simply vanishes and the market goes no bid. This happened briefly in March 2020. It happened briefly in September 2019. Next time, with $36 trillion in debt, the suppression mechanism won't be enough. The dam will break. So, what happens when you run a $2 trillion deficit with no real buyers and rely on a choked banking system to hide the problem? You don't necessarily get an overnight Mad Max collapse. That is the Hollywood version. The reality is slower, more painful, and more insidious. You get the great erosion. The demand gap is not just a number on a spreadsheet. It is a black hole that sucks the vitality out of the real economy to keep the government solvent. Here is the roadmap of what the demand gap inevitably leads to. 1. Structural inflation, the invisible default. This is the most direct consequence. If foreigners won't buy the debt and the private sector is full, there's only one buyer left, the Federal Reserve. Eventually, the Fed will be forced to move from suppressing volatility to monetizing debt. They may call it yield curve control, YCC. They may call it QE infinity. But the mechanics are simple. The Fed prints new dollars to buy the bonds that China and India refuse to buy. This is monetization. When you print money to fund a deficit, you devalue the currency. The demand gap is filled by inflation. The government gets funded, but your paycheck buys less. Your grocery bill goes up. Your energy costs rise. We are effectively transferring the cost of the debt from the foreign bondholder to the American consumer. You are the buyer of last resort. You're paying for the deficit through the erosion of your purchasing power. This explains why gold and commodities are rising even when the economy slows. The market smells the monetization coming. 2. The crowding out effect, the starvation of Main Street. As we discussed, the primary dealers are stuffing their balance sheets with treasuries because they have to. Banks have a finite amount of balance sheet capacity, regulatory capital. If that capacity is filled with government debt, it cannot be used for anything else. Every dollar of balance sheet space used to warehouse a treasury bond is a dollar that cannot be lent to a small business. It cannot be used to underwrite a corporate bond for a factory. It cannot be used to issue a mortgage. This is called crowding out. The government's insatiable hunger for cash sucks all the oxygen out of the credit markets. The result is a bifurcated economy. The government and the largest corporations, who have access to bond markets, get funding. Small and medium businesses, the engines of real growth, get starved. Credit spreads widen. Lending standards tighten. The real economy stagnates or enters a recession even while the government economy booms with spending. This leads to stagflation, slow growth combined with high inflation. It is the worst of all worlds. 3. Currency volatility and the loss of privilege. As the U.S. relies more on hot money, hedge funds, to fund its deficit, the U.S. dollar changes its character. It stops acting like a boring store of value and starts acting like a volatile risk asset. We will see violent swings in the dollar index. When the repo market is tight, the dollar will spike, wrecking emerging markets. When the Fed prints to fix it, the dollar will crash, importing inflation. The stability of the world reserve currency will vanish. This accelerates the exit of nations like India and the global south. They see the volatility and say, we want out, we want gold, we want local currencies. The demand gap becomes a self-fulfilling prophecy. The harder we try to fake the demand, the more we drive away the real buyers. 4. The eventual reset. The fiscal dominance moment. The demand gap cannot be hidden forever. Eventually, the mathematics of compound interest win. With $36 trillion in debt and rates at 4.5%, the interest expense alone is overtaking the defense budget. It is overtaking Medicare. We are borrowing money just to pay the interest on the money we borrowed. This is a debt spiral. At some point, likely in the next 18 to 24 months, an auction will fail. The primary dealers will simply refuse to bid. They will say, we are full, no more. Yields will unglue. They will spike to 6%, 7%, 8% in days. The stock market will crash. The banking system will freeze. And in that moment, the Federal Reserve will have to make the ultimate choice. Option A, let the U.S. government default, political suicide. Option B, print the money to buy all of it, currency destruction. They will choose option B. They always do. That is the moment of fiscal dominance. The moment the central bank loses control and becomes a servant of the Treasury. That is the start of the high inflation era that resets the debt burden. 5. The U.S. debt market is clearing, but it is not healthy. It is a patient on high-dose stimulants. It is being kept alive by a life support system of dealer inventory, repo leverage, and geopolitical strong-arming. The real buyers, the surplus nations of the world, have left the building. The demand gap is real, it is structural, and it is growing every day. And right now, that gap is being filled by the invisible tax of inflation that you pay every single day. Do not mistake the lack of a crash for safety. It is simply the silence before the dam breaks. This is Archivist. The protocol is active. Class dismissed.